For a very long time, silver has been treated like an afterthought, not because it lacks value, but because it sits in an uncomfortable space between money and industry. And that is exactly why moments like this matter. When silver suddenly moves hard, fast, and without apology, it is not speculation waking up. It is reality catching up. Welcome back to Gold Rush Reporter. Today's breakdown is important because silver is no longer creeping higher quietly. It is forcing conversations in places that usually ignore it. When silver trades north of $70 and refuses to cool off, the market is telling you something structural has shifted. This is not about hype. This is about pressure. What you are seeing right now is silver reacting to a world that is changing faster than supply chains can adapt. Industrial demand is rising, energy systems are being rebuilt, artificial intelligence is consuming raw materials at scale, and geopolitical stress is increasing the value of tangible assets. Silver sits at the intersection of all of this. That is why I want to frame today's discussion properly. Silver is not moving because people suddenly love coins. It is moving because the modern economy is demanding more from a metal that was already stretched thin. One of the most important points made in this discussion is that gold leads and silver follows. That has always been the case. Gold moves first because it is strategic. It responds to stress, conflict, inflation, and monetary uncertainty. Silver then accelerates because it is smaller, thinner, and tied directly to industrial usage. Silver is not gold's twin. It is gold's amplifier. When gold breaks out, silver does not politely follow. It surges. That is what you are witnessing now. And unlike past cycles where silver demand was largely financial, today's demand is rooted in real-world usage. Solar panels, power grids, data centers, medical technology, and electronics are not optional. They are expanding. At the same time, supply is not responding. Mining is slow, capital-intensive, and politically constrained. You cannot flip a switch and produce more silver. That imbalance does not resolve quickly. Now layer on top of that the AI build-out. This is where many people underestimate what is happening. Artificial intelligence is not just software. It is hardware, energy, infrastructure, and metals. It requires enormous amounts of electricity, copper, and silver to function. That demand is not theoretical. It is being built right now. This is why comparisons to past silver spikes fall short. The 1970s were monetary. The early 2000s were speculative. Today is industrial and strategic at the same time. That combination is rare. This does not mean silver will go straight up. Volatility is guaranteed. Pullbacks will be violent. Anyone telling you otherwise is lying. But volatility does not negate value. It confirms stress. Silver is no longer being priced as a forgotten metal. It is being repriced as a critical input. And this is just the beginning of the conversation. To understand why silver is behaving differently this time, you have to look at what is driving demand, not just how fast price is moving. Most people still think of silver as a monetary metal that occasionally gets hot when inflation fears spike. That view is outdated. Silver is now being pulled by forces that are structural, not cyclical. The biggest of those forces is energy. Every serious conversation about the future of the global economy eventually comes back to energy production and energy efficiency. Artificial intelligence, data centers, electrification, grid expansion, and industrial automation all require massive increases in power generation. And power generation is meaningless without transmission. That transmission relies heavily on metals, especially silver and copper. Silver's role here is often underestimated because it is used in small amounts per unit. But scale changes everything. When millions of solar panels, servers, sensors, and electronic components are produced, those small amounts add up very quickly. This is not optional demand. These systems do not function without silver. That is why AI matters so much in this discussion. AI is not just software running in the cloud. It is physical infrastructure. Data centers consume enormous amounts of electricity, require constant cooling, and rely on highly efficient electrical components. Silver's conductivity makes it irreplaceable in many of these applications. There is no cheaper metal that performs the same function without trade-offs. This is where the idea of commodities becoming luxuries starts to make sense. For decades, the global economy benefited from cheap energy, cheap labor, and outsourced production. That era is ending. Nations are now prioritizing security, resilience, and domestic production over efficiency alone. That shift is inflationary by nature, and it is metal intensive. Silver benefits directly from this transition. At the same time, mine supply is not growing fast enough to meet this new demand profile. Silver is mostly produced as a byproduct of other mining operations. That means production does not respond directly to higher silver prices. Even if silver doubles, miners do not suddenly double output. This creates a lag that keeps supply constrained during demand surges. This is why silver spikes are so violent. The market is thin, inventories are limited, and demand can rise quickly. When price starts moving, there is very little resistance. Now compare silver to gold in this environment. Gold benefits primarily from monetary stress, currency debasement, and geopolitical uncertainty. Silver benefits from all of that, plus industrial demand. That dual role makes silver more volatile, but also more sensitive to global change. This is why silver often underperforms early and overperforms late. It lags when fear is abstract and explodes when fear becomes physical. Another important point is re-industrialization. The world is not deglobalizing quietly. Supply chains are being shortened, duplicated, and secured. This requires rebuilding factories, infrastructure, and logistics networks. All of that requires metals. And unlike financial assets, metals cannot be created with keystrokes. Copper often gets the spotlight here, and rightly so. But silver is embedded deeper into high-value components. It is not poured by the ton, but it is essential where performance matters. That makes it harder to substitute and harder to economize away. This is also why silver's price sensitivity is extreme. It does not take trillions of dollars to move silver. It takes marginal shifts in allocation. When institutions, manufacturers, or even governments decide they need to secure supply, price adjusts rapidly. This is not a bubble dynamic. It is a scarcity response. That does not mean risk disappears. Silver will correct. It always does. Margin hikes, profit-taking, and sentiment shifts will create sharp pullbacks. Anyone buying silver must accept that reality. But those pullbacks do not solve the underlying problem of constrained supply meeting rising demand. Silver is no longer just reacting to monetary fear. It is reacting to physical necessity. As silver demand shifts from optional to essential, the way it trades in financial markets becomes increasingly unstable. This is where many investors get confused because they expect price discovery to behave smoothly. Silver does not work that way. It never has. And in the current environment, that dysfunction is becoming more visible. The silver market is small. That is not an opinion. It is a structural fact. Compared to equities, bonds, or even gold, silver is thinly traded relative to the value it supports in the real economy. That creates a mismatch between paper trading and physical demand, especially when demand rises quickly. Futures markets were designed to manage risk and smooth price volatility. In silver, they often do the opposite. When speculative volume overwhelms physical flow, price can be pushed around in the short term. That is where the constant arguments about suppression come from. Most of that debate is poorly framed. There is no need for a secret conspiracy to explain silver's behavior. The structure itself creates distortion. Large participants hedge production, industrial users hedge consumption, and traders exploit liquidity gaps. The result is a market that can look artificially calm right up until it breaks. When it breaks, it moves violently. This is why silver often trades sideways for long periods and then explodes in a very short time. The futures market absorbs pressure until it cannot. At that point, price has to catch up with reality quickly. That is not manipulation. That is compression and release. Volatility is increasing because the underlying forces are becoming more extreme. Industrial users are less price sensitive than speculators. If a manufacturer needs silver to keep production running, they pay the price. They cannot wait for a pullback that may never come. That creates upward pressure that paper markets struggle to contain. At the same time, investment demand is waking up. Not in a frenzy, but in a reallocation. Investors who ignored silver for years are starting to notice that it is outperforming expectations. When capital flows into a small market, price reacts disproportionately. This is also where margin dynamics matter. Silver futures are highly leveraged. When price rises quickly, exchanges raise margin requirements to reduce risk. That forces some traders to liquidate positions, causing sharp pullbacks. These drops are often misinterpreted as weakness. In reality, they are mechanical resets. What matters is what happens after the reset. In strong markets, silver does not collapse. It consolidates at higher levels. That is what differentiates a structural move from a speculative spike. Another critical factor is inventory. Visible silver inventories have been declining, and what remains is not evenly distributed. Much of the silver that exists is already committed to industrial use. That means less is available to satisfy sudden investment demand. When both compete for the same metal, price discovery becomes chaotic. This is where physical premiums start to matter. When paper prices fall, but physical premiums rise, the market is telling you supply is tight. That divergence is not sustainable long term. Either paper prices rise, or physical demand destroys available inventory. This tension is why silver cannot stay cheap in a world that demands more of it every year. Price suppression narratives miss the point. The system is not suppressing silver forever. It is delaying repricing. Delay increases the eventual adjustment. Silver's volatility is not a flaw. It is a signal. It reflects stress between financial abstraction and physical reality. The more the economy depends on silver, the harder it becomes to manage that stress quietly. This also explains why silver tends to overshoot. When price finally moves, it does not stop at fair value. It pushes past it. That is how thin markets clear. Investors who expect smooth, orderly appreciation will be disappointed. Investors who understand silver's nature will not. To truly understand silver's trajectory today, it helps to look at history, but with one crucial adjustment: context. Past silver spikes often centered around monetary crises, speculative bubbles, or short-term industrial shocks. The 1970s, for example, saw silver prices soar during inflationary fears and geopolitical instability. The early 2000s saw a sharp move as financial speculation coincided with supply tightening. But today's cycle is fundamentally different. This is not purely speculative. It is anchored in real-world demand that is growing exponentially. AI, electrification, industrial retooling, and re-industrialization programs globally are consuming metals faster than production can respond. The driver is not sentiment. It is necessity. That changes how you analyze risk and opportunity. One key difference is silver's dual role. Historically, its value often lagged behind gold during crises. Today, silver benefits from both monetary concerns and industrial demand simultaneously. That makes it far more sensitive to macro and micro factors. Each surge is amplified, each pullback deeper, but the trend remains structurally bullish. Inventory dynamics also differentiate this cycle. Global silver stockpiles are limited. Mines produce at a slow pace, and much of the existing silver is already allocated for industrial use or held by investors. Unlike paper assets, you cannot magically increase supply overnight. This structural scarcity means that even minor surges in demand can trigger outsized price moves. Another factor is the re-industrialization trend. Countries are reshoring critical industries and building domestic capacity. The United States, China, Europe, and India are all investing heavily in AI infrastructure, renewable energy, and electrification. These projects are capital and metal intensive, with silver playing an essential role in circuitry, energy transmission, and specialized industrial applications. This is not speculative growth. It is a physical, unavoidable need. Platinum and palladium illustrate a similar dynamic. Their industrial importance became obvious during the last decade, and their price moves have foreshadowed silver's potential. Unlike gold, which functions primarily as a monetary and strategic asset, silver reacts directly to physical demand. And because silver's market is smaller and thinner, any imbalance is amplified dramatically. Geopolitical tension further complicates the picture. Central banks are not only holding gold as reserves, they are also monitoring metals like silver and copper for industrial security. Supply chain risk, export restrictions, and political volatility all create structural pressure. For example, when a major producer restricts exports, physical supply tightens immediately, while paper markets adjust with a lag. That lag creates spikes that often exceed analyst expectations. Now, let's talk about volatility versus structural trend. Critics often mistake volatility for weakness. They point to sudden pullbacks in silver price and conclude the rally is over. But these pullbacks are part of the market's natural clearing mechanism. In thin, high-demand markets, volatility is a symptom of stress, not a signal that the metal is losing value. Experienced investors recognize that consolidation phases are temporary pauses before the next leg up. Finally, risk management is essential. Silver's explosive potential does not eliminate the possibility of sharp declines. Futures margin hikes, speculative profit-taking, or liquidity constraints can trigger temporary drops. But the underlying fundamentals, rising industrial demand, constrained supply, and geopolitical factors remain intact. These are the structural supports that differentiate today's silver cycle from mere speculative bubbles of the past. Now that we've examined the structural drivers, historical context, and market mechanics, it's time to discuss what this means for investors. Silver is not behaving like a typical commodity. It is no longer just a hedge or a speculative play. It is increasingly a strategic industrial and monetary asset. That dual role creates both massive opportunity and significant risk. First, understand that volatility is part of the game. Silver will continue to swing sharply, sometimes in a single day. Margin hikes, news events, and liquidity gaps can trigger short-term pullbacks. These moves can feel dramatic, especially if you are new to the market. But remember, the structural story does not change because of daily price fluctuations. Silver's real value is tied to physical scarcity, industrial demand, and macroeconomic forces. These fundamentals support a long-term uptrend. Second, positioning matters. Because silver's market is thin, large trades and institutional activity have an outsized impact on price. Retail investors should focus on accumulation over time rather than attempting to time the top. Look for opportunities during natural pauses or dips caused by margin adjustments or technical corrections. Buying in tranches reduces risk while maintaining exposure to upside potential. Third, industrial and technological adoption will continue to drive demand. AI infrastructure, renewable energy projects, and electronics all require silver in quantities that cannot be substituted easily. As global economies expand and re-industrialize, this demand will only increase. Physical silver, bars, coins, and allocated accounts offers a direct way to participate in this trend without the added complexity of futures leverage. Consider this a hedge against both inflation and industrial scarcity. Fourth, monitor geopolitical and supply-side developments. Export restrictions, mining delays, and policy changes can trigger rapid price moves. Investors should track news from major producers, central banks, and trade authorities. Awareness of supply constraints will give context to sudden price surges or dips, allowing you to act rationally rather than emotionally. Fifth, consider the broader commodity landscape. Silver is not moving in isolation. Copper, platinum, palladium, and gold all react to similar industrial and monetary forces. Understanding correlations helps you manage risk and identify diversification opportunities. For instance, a spike in platinum or palladium may signal future pressure on silver due to substitution or market attention. Tracking metals holistically improves decision-making. Sixth, think long-term. Short-term swings can be dramatic, but the structural story points to sustained growth over the next several years. Historical parallels suggest that silver cycles can last months or even years, with intermittent corrections along the way. Investors who remain disciplined, maintain allocated positions, and avoid chasing price extremes are more likely to capture the full upside. Finally, be disciplined in risk management. Never over-leverage or invest money you cannot afford to set aside. Silver's volatility is both a friend and a threat. It can multiply gains, but also amplify losses. Focus on education, strategy, and a clear understanding of supply-demand fundamentals. Diversification within metals, industrial assets, or other safe haven vehicles will help protect against extreme swings. In summary, silver is entering a structurally bullish phase unlike most cycles in recent history. Physical scarcity, rising industrial adoption, AI-driven productivity, and global re-industrialization all point to sustained upward pressure. Volatility is inevitable, but it is a feature of the market, not a flaw. Patience, allocation, and awareness of supply-demand fundamentals will be critical for investors seeking to benefit. Silver is no longer just a retail version of gold. It is a core strategic metal with real-world necessity, financial leverage, and long-term value potential. By understanding these dynamics, positioning wisely, and managing risk, investors can navigate both the spikes and pauses effectively. As always, this information is for educational and entertainment purposes only. It is not financial advice. Do your own research, DYOR, consider your risk tolerance, and consult professionals if needed before making investment decisions. Silver's story is unfolding rapidly, and those who pay attention to fundamentals, structural trends, and industrial demand are likely to be the ones who benefit the most. The market is volatile, the opportunity is real, and timing will be critical, but the underlying forces suggest that this cycle is far from over.